pre-pandemic, we were, between 4.5% and 5%. And then pandemic, we're, clear down sub 3%, skyrocket up to 8%. It's just been a wild swing in the last 8 years as far as what the interest rate has done.
FHA loans, I think, became ineligible for immigrants without permanent residence, and including these H-1B visa holders.
We're showing a $198 billion surplus in a month where the government shut down because they can't agree on how to work out a budget to continue to move forward.
And you won't go to Zillow anymore. You'll go to OpenAI to look for all things, to buy toothpaste as well as to buy a house. It's just how it goes. Episode 62 of Market Moves with Mark and Jeff, two uninteresting guys talking about very interesting times. Jeff, it's good to be back with you today.
Great to be here, Mark. Definitely interesting times, which I think is, one of the themes of this podcast, but definitely gives us stuff to be looking at and reporting on. So great to be here.
Yeah, it is good. I think it's great to be talking about this market. To me, maybe a shoulder to cry on or a therapist to kind of go through, because I think it is a really nasty market out there. We've talked multiple times on this podcast about this, what I think is kind of a cruel experiment that the federal monetary policy has been over the last 2.5+ decades. I think a lot would argue maybe even back into the 70s or something, that it's all culminating now. But it's creating a lot of pockets of mortgage application stagnation is kind of what I would call it, Jeff. And I don't know. It's really hard to read, and we only get the data kind of well after it all takes place. But it feels like we created another pocket after some excitement with rates dropping from 6.8, 6.9 down to 6.13, I think, at their lowest. And then after Powell spoke, of course, and lowered rates, they jumped up to 6.4, and we have been then in this pocket of low mortgage applications since. That how you're feeling? What are you seeing going on right now?
Yeah, I think that's exactly right. And I remember even just last week citing an anecdote of that very scenario playing out, where when the Fed is signaling, we're going to cut rates several times between now and the end of the year, a lot of people that aren't compelled to move immediately due to circumstances are just as happy to sit on the fence and wait. And why not, if you expect that you're going to get more favorable rates and borrowing terms in 1, 2, or 3 months from now, as opposed to pulling the trigger today. And so it definitely seems to be, having that effect. It seems that there are multiple things converging. Affordability, we've talked a lot about, and I continue to think about, it's interesting to me that the perception of affordability is tied to high home prices, not necessarily where the interest rate has been. But on a recent episode, we talked about how dramatically prices would have to come down or interest rates have to be cut in order to get back to pre-pandemic affordability. And so something's got to give. It isn't really giving in the moment, other than just marginal interest rate drops that, will pull a few people off the sidelines, but not the volume that I think a lot of the mortgage or just real estate professionals need in order to make a meaningful impact in volumes, that we're seeing on the ground.
We continue on this path of a ridiculous amount of uncertainty on a lot of levels, but certainly interest rates. And this has been an ongoing problem for 2 years or more, where rates are just going to be different at some point than they are right now, and that causes a bunch of people to wait. And I've got so many anecdotes in my life, so this has not been the case. Let's say 6 months ago back to 30 months ago. So like a 2-year period, I kept looking up and saying, man, the things that are happening, I don't see in my daily, the economy, I think, is struggling on some level, but the airplanes, Las Vegas and everywhere is really full. That's been changing the last little bit. I hear a lot of people struggling on a lot of different levels. I see a lot of people waiting to make real estate decisions based on the rates that are now, and all sorts of things that we'll talk about today and have talked a little bit about on this podcast of federal policy kind of immediately coming down and affecting the housing market for sure. So I don't know. This is the cruel experiment in my mind was really trying to, I think, loose lending practices that led to the great financial crisis, but then also all of the efforts to kind of quote unquote save the market and the economy in all of the darn money printing, and then the reduction of rates and continued money printing through COVID has just put us in this kind of cruel human experiment, psychological experiment on home ownership, home affordability. I don't know, just even the psychology of, do you own a home? Should you? And if so, when? Are you already locked out of it? All those things I think are going on. And if we look just strictly at the Fed's path of trickling in mortgage draw or federal rate relief over the next 3, 4, 5, 6 months, longer, whatever it is, this creates inactivity in the housing market, which is decimating the economy. They have to know that. They have to have an understanding of that, and are continuing to move along. Just making a full 100 basis point drop would be, and not doing anything for 4 or 5 months would be a lot better than what we're getting now. So just a lot of thoughts and maybe even a little frustration, I think, that I can't keep down, Jeff, because it's frustrating to continue to be here.
Yeah, it definitely is. And, one of the things I'm observing is that uncertainty as to what to expect tomorrow leads to inaction and the lack of investment. Whereas, you never know for sure, but a higher level of certainty in policies, in interest rate expectations, in economic outlook, all lead to greater action and greater investment going forward. And I think we're seeing a lot of people just holding back due to the uncertainty. This is maybe, I don't know if interesting or not, but it's an anecdote. I've gotten to know somebody who works on the personal property appraisal side for the IRS in the government. And, just speaking anecdotally, the level of uncertainty, even within the operations of the government and the IRS, under the Department of Treasury, is incredibly high. I mean, they've been furloughed recently. The tax filing extension deadline just passed, while a large number of the staff were on furlough, and it makes it really hard for people to take action. And this individual was citing, like, I can't legally answer questions or give guidance to people that are trying to file by the deadline, and all of those sorts of things. And so it just leads to inactivity because there's just not this certainty, in terms of having people off furlough and operational like they're accustomed to being. And so I wonder to what extent there's a trickle out effect of this uncertainty that just leads to a lack of action that would otherwise take place, that's probably rational and logical to make, except for the unclear expectation of what the future is going to hold in the near term.
Yeah, and it of course goes beyond interest rate policy from the Fed. And I was just listening to Tesla's quarterly earning call last night, and they had a dominant energy sector for the last quarter. And we're talking about the residential solar. And we've talked about this on 5 or 10 episodes ago when they removed the subsidies for homeowners installing solar on their houses, but that it was actually going to be a boon for certain solar companies. And, Tesla was talking about building up their lease program, installing solar panels on roofs. And it was a really good quarter for them. They expect it to be the next 2 quarters to be really strong. And then that feeds into this lease program. So there's a lot of winners and losers from these major policy changes, and not always predictable to the layperson. And I don't think there's a whole hell of a lot of winners right now in the housing market, and certainly in mortgage finance. And it's a little frustrating because, I think we would have had relief by now. That would have been my expectation, whoever the darn president was that came in. I think we keep hearing that 2026 is the time, and it may be setting up that way. I think we could expect some pretty deep rate cuts, maybe all at once. I don't know, but I certainly hope they would be. So, Jeff, you may have comments there. Let's get to those, and then let's get to the interest rate charts that we have, so that we can get into the implications of all of that.
My only additional observation before we jump in and look at these is, I've heard the mantra of survive until 25, and then it's become survive through 25. I'm just hoping it's not take more licks in 2026 because we're struggling. I mean, the volumes are just historically low. Like any chart that you look at in terms of originations, in terms of home sales, everything is down. I mean, way down. And on the one hand, that means that there's room for it to recover even back to historically normal levels, which everybody would welcome, from appraisers doing appraisals to agents selling homes to mortgage originators, originating the loans. There's definitely upside in the market, but to your point, it's just hard to know when to expect a real meaningful shift. And I think one of the silver linings is we're not talking about going back to historically high volume rates. We're just talking about getting back to historically average or normal, volumes would be a real boon for everybody in the space. And so we're not needing something other than a reversion to the mean. I'm just hoping we get there.
You bet. Well, I talked a little bit about this at the outset, but as we record today, rates are sitting at 6.17% for a 30-year fixed. This is down from 6.8 from 4 or 5 months ago, and where they had been sitting for quite a while. Almost since that time, anytime you look up or any headline that you read, you will see that rates are lower this year than they were last year, which talks about the nightmare that we were in last year. And remember, we got a lot of rate relief when the election was kind of settled one way or another. So rates were really high last year and not so much this year, but rates are down at 6.17 right now, Jeff, and they have dropped from 6.4% before this government shutdown. And, I think the surprising thing, and you'll get into this in some of the charts below, is that where 613 a month or two ago had a little like a mini boomlet of mortgage applications, we're really not seeing a lot of that a month later with rates at the same level.
Yeah, I think that's exactly right. In fact, I'll navigate to. We've got a chart that just shows the historic, interest rates, and it's interesting to see. Pre-pandemic, we were, between 4.5% and 5%, and then pandemic, we're, clear down sub 3%, skyrocket up to 8%. It's just been a wild swing in the last 8 years as far as what the interest rate has done. But I think what you're referencing and what we're starting to see is because the Fed is signaling, we're going to continue to cut some rates. There have been little boomlets of activity, both on the purchase side as well as on the refi side. But when the expectation is throughout the last quarter of the year that rates are going to get better, even though they have gotten better, we're at the 6.17 that you referenced. It's not driving a lot of volume because the expectation is we're not going to stop there. It's going to get even better from here. And so, what had been in the past boomlets where there wasn't the expectation of additional successive rate cuts, now that we're in that environment, it's not leading to the volumes that you might otherwise expect. The rate being down as close to 6 as we've seen it in a long time, would otherwise you'd expect it to be to.
You bet. And what is causing the rates to be down? And what I think is going to happen is that so interesting to note is that government shutdowns lower rates. I think all of this is a little counterintuitive to me, but my understanding is that the reason that mortgage rates drop during government shutdowns is because anytime there is additional uncertainty in the market, investors run to U.S. Treasuries. When there is more demand for U.S. Treasuries, that lowers the Treasury rate. The Treasury rate is loosely correlated with mortgage rates. So we have mortgage rates go down. Well, when certainty regains steam, then investors go back to the risk on assets, less demand for Treasury, and that will rise. So we're in a pocket right now of lower rates. We aren't seeing a big uptick in applications, more refinance or purchase, a little bit in refinance, but none really in purchase, no uptick. And then we're going to have them go back up, once the government kind of comes back in. So it's just part of the cruel psychological experiment of any forecast saying, oh, well, I forecast if the government shuts down, rates are going to drop. So we'll see another mini boomlet of mortgage applications. No, no, no. You forgot about this other undercurrent that turns out to be a headwind. So I'll stop there, Jeff. There's one more interest rate policy thing that I want to talk about, but any comments there so far?
Well, I think just to emphasize your last point, Mark, that there are a multitude of currents that are all kind of flowing together, but what you think is going to happen based on one particular thing, whether it's the government shutdown or expected Fed rate cuts and changes in policy, or their quantitative easing or tightening as to how they what they're doing in terms of the supply of money, any number or combination of those things just make it incredibly difficult to really predict what the future is going to hold. I mean, you constantly see even some of the largest players like Fannie Mae and others revising and amending what their interest rate expectations and projections are, because it is just such a moving target, literally, that I think we all want to have a good sense of what the future is going to hold, and we certainly all have an opinion about it, but it's hard to be very accurate, especially very far into the future, given how complex and dynamic the undercurrents are that all converge in affecting what the headline interest rate is at any given point in time.
Amen to that. Amen to that. There is an undercurrent that is ongoing that I think can have more lasting impact. And we had a prediction midway through the year that we touched on a little bit earlier, and it's kind of along the lines of how low can rates go. I saw I think it was a Polymarket prediction market for rates being below 6 or above 6 by year's end, I think it was, and quite a bit more votes for it being under 5 than I think most people would assume. Maybe 34%, 35%, something like that, chance that rates would be under 5 or under 6. I'm sorry,
under 6. Yeah, under 5 would be really exciting.
Yeah. So, I think what we're seeing right now with rates low are tied to something that is temporary and won't last. I don't think the government will shut down till January, but Fed policy change that is a little under the radar because the interest rate determination makes so much headline, but it is, for really since the great financial crisis, we have had this phenomenon called quantitative easing, a tool that the Fed uses to regulate the amount of money supply in the market. And it's essentially when they're easing, they are selling mortgage-backed securities. Do I have this right, Jeff? I think I do.
I think they're buying the mortgage-backed securities.
Thank you. Yes. So, so quantitative, work with me here because, man, I've done some mental gymnastics getting through it because it gets even more confusing. But so they are buying them. So they are putting money into the market in that way. So they've been doing that for 15 years. Here during COVID or after COVID, in interest rate rise policy, they began quantitative tightening, which means that they are selling mortgage-backed securities. They are reducing their balance sheet that holds mortgage-backed securities. They have signaled over the last month that they are going to stop quantitative tightening. I don't think they're buying. I don't think they're selling. I think they're just sitting neutral and letting mortgage-backed security bonds just expire that sort of reach the end of the term. But this has a larger and more long-lasting impact on mortgage rates in a positive one. And so I think as we've seen this poly market kind of rise in likelihood that rates would be under 6%, this is something that we can point to say that if the Fed holds to what they've talked about, which is kind of halting for as far as the eye can see here, the quantitative tightening, we may end up seeing rates below 5 and maybe even meaningfully below 6 and meaningfully below 6.
It's that wishful thinking I know keeps bubbling up, Mark. Of, why stop at 5? At 6, let's get under 5. But no, I think that makes sense. And it occurs to me we probably have some contacts we can draw on that would be a really fun conversation. Some economists that could probably give us a better kind of deep dive as to how these policies, how the tightening and easing, if how it works and what the direct impact is on the interest rates. But I think it's an interesting point that there's this, the shift not just in what the Fed's targeting for an interest rate, but also in their money supply policy that can have an impact on mortgage rates. And I mean, everybody that I know would welcome them under 6%, going forward, and that seems to be at least another tailwind in moving that direction, assuming that they hold. Now they meet next week, I believe it is, and it'll be interesting to get an update not just on interest rate target, but also on their monetary policy as well.
It will be. I think we talked about last week that some 99% chance or expectation that Powell's going to lower the rates 25 basis points. Hope so. I think there's justification for quite a bit more than that. I hope they would do it. Maybe I doubt they will. They think quantitative tightening or pausing of the tightening can help. We'll see. Side note, inside baseball with market moves is that, Jeff, I think we've hit the kind of the edit button no more than 5 times in the 62 episodes that we've covered here. We kind of go at this live, and what you see is what you get. And I think we both have had a couple of instances here over the last 5 minutes that maybe more perfectionist folks would hit the edit button, but we're gonna roll right through.
I love powering through our imperfections, because the problem is I know we don't have the bandwidth to go in and try to make ourselves look and sound smarter than we really are. But it has, speaking of the inside baseball, it has been interesting to just kind of sense as we've done this a little bit. Certainly there are gaffes, there are mistakes. I kind of like the authentic, like it's just two guys having a conversation approach, as opposed to a very polished and edited, output. But we've gotten at least more comfortable with having the conversations, going back and forth. We referenced, I think just recently as well, a successful podcaster saying, you just have to stick with it for a really long time and do it when it doesn't make sense. You just get better at it. You learn from falling down and getting back up again. And I think, we're still in the learning process. I don't even know if we're ready to take the training wheels off, so to speak. But we're a work in progress, I guess, just to acknowledge that as much as anything.
Yeah. Well, on we go. It is fun to give it a shot, at least. So, well, Jeff, from rates in where we are, kind of taking us into the market. We talked a lot about this. This is Lennar's. We have a graph on the screen for the audio listeners. This is Lennar's average price. I think it's average, maybe median, but roughly, it's average selling price. Average sell price, yep. Yeah, that in 2023 peaked at about $491,000. It is a 22% decline, down to what, maybe 389, or no, I guess we are now at 383,000. Boy, I hear all through my market talking about the quality choices that builders are making, just to try and meet the affordability. That is the market that they're attacking, right? It is, how do I get a monthly payment that is unmatched anywhere in the marketplace to get people in and move homes? And so, we've talked about, instead of upgraded countertops and cabinets, buy down the rate. Instead of, whatever, higher ceilings or better windows or better flooring, it is a lower price, right? And so those are the ways that we're getting at these. And I think some of the 22% decline is not just price drop. That would be really drastic here. I think some of it is trying to do a better job of meeting the affordability expectation and where demand is. So it's just building a lower quality product to be able to move it and meet that.
And I think in addition to that, it's also smaller homes and targeting more like the models themselves that they're building are less of the larger, higher end kind of move up market type of product and more of the just smaller footprint type of product as well. So I think you're right. I don't think it's the exact same model has necessarily decreased by 22%, but they're selling lower end product across the board. Maybe I shared this with us last time we were talking about it, Mark, but it kind of caught my attention that I went in to do an appraisal on a new home built by a local builder here where I'm at, and they had like rolled out vinyl like flooring and Formica countertops in a brand new home, which I just haven't seen in almost forever, even as they're trying to bring on product, that's affordable. It was just interesting. I was like, holy crap, I haven't seen that in a really long time in a brand new home. And I think probably a kind of a sign of the times as far as, what we're going through. I'm not seeing that widespread across the board yet, but there's multiple ways to try to get at this affordability challenge, and that's certainly one of them. Is the upgrades you thought almost became like the new default baseline, maybe won't be going forward. It'll be interesting to see.
Yeah, you bet. And we've got a Lennar chart up here because it was accessible and in front of us, but I think I'm showing it because this is the story of most builders around the country, that everybody is doing this. This has been the market opportunity. It is building in suburban outside locations. We talked last week about zoning and permitting being one of many problems of trying to build in urban environments. And so here we are. So, and I think on some level, we've been seeing this, that they are also trying to meet lower demand levels and still move product. And you've got to do all of these things to meet that market reality one way or another. So, Jeff, we've got the next one slide that we've got here, I thought was really, really interesting. And it is essentially showing that 6% at the height, 6% of FHA transactions over the last, during the summer, roughly, have been by folks that were without permanent residency, immigrants without permanent residency, including H-1B visa holders. H-1B is the work visa that a lot of tech companies use and has been in the news quite a bit. I think Trump's had his eye on some of the abuses that seem to exist in making this happen. Maybe bringing overseas folks in, holding this visa over their heads. They charge them or pay them lower salaries, and then they're taking a job that an American worker would have got, right? That's kind of the argument against the wide use of H-1B visas. But FHA loans, I think, became ineligible for immigrants without permanent residence, and including these H-1B visa holders. And so in May, let's say that they were that FHA loans went to immigrants without permanent residency for over 6%, 6.2%, let's say something like that. And then in the next month, June, was somewhere in the 5.5%. And then the ban takes place, and it is down to 0.5% of FHA loans are made up of immigrants without permanent residency. And that has held for 3 months into September, as best I can tell. And Jeff, this mirrors a story that I talked about with an appraisal on a series of new development townhomes that I was doing. I would guess that the developer was foreign born. He talked about his investors that were out of country. And he would sell in the shadows of the Galleria area in Houston, which is kind of a like urban retail popular area to be in. That he would sell all of these things to foreigners, and he was going to build these and rent them, even though they were on the luxurious side, because all of his buyers had dried up. And here we have a chart following that talks about a deep discount, not discount, but reduction in FHA loans as a percentage of total FHA loans going to these immigrants without permanent residency, Jeff. And, if FHA loans have risen, correct me if I'm wrong, maybe 40% now, is that about what your read is on the percentage of FHA loans to total loans?
I think it's in that ballpark. Yeah.
So it's risen a lot in the high interest rate period. And so if you have a roughly 5% drop of 40%, that's 2 or 3% drop in mortgage applications at large. And that is very meaningful given the historical lows that we've got. So I've been fascinated by this story and some of these policies sort of hitting mortgage professionals all over in less applications.
Yeah, that's the thing that stands out to me is how big of a swing a government policy has in what has historically, and in this chart that we're looking at, goes back to February of 2018. where it's escalated over time, and it tracks, fairly closely with a change in president and administration, and then the policies they implement, and whatever side of the fence you fall on in terms of identifying with the president and their policies, the data shows what the impact tended to be one way or the other during those time periods. And it goes from just a big drop as soon as we implement that policy shift, and a meaningful impact on overall volumes. I think, as you highlighted, Mark. So definitely interesting to see, and just one example of many, where policy changes, and that change then has a direct impact on how many people qualify to get a loan and take out a mortgage that might have otherwise. There was no indication. If anything, this chart was up and to the right until this policy change, and then it falls off of a cliff. And that's not change in buyer preference. That's not change in market participants. It's a policy change that just kicks people out of the market that were otherwise, showing kind of an increasing trend towards, being active market participants.
Yeah, I think this is a good example of some of the undercurrents that are underestimated or not included in an estimate at all, that are just kicking mortgage professionals of all kinds in the service business in and around this space. That in addition to the trickle down interest rate policy of the Fed, holding on to the quantitative tightening for as long as they did, and on and on. I mean, there's just a lot, and I think mortgage professionals writ large can't take any of these hits, and they keep happening. So frustrating. Jeff, on jumping to the next slide, we are getting some results, and I think the plan is short-term pain for a lot of growth in 2026, and we had yet another national surplus in economy of $200 billion. I'm not sure how many in a row this is, but this is a nice progression. A lot of pain. We've been spending the first 30 minutes of this podcast talking about some of that pain, and it isn't anymore just narrowed or siloed to real estate professionals. It's now reaching industries all over. But boy, are we having some deficit progress.
Yeah, this chart in particular is interesting to me, and not lost on me that we're showing a $198 billion surplus in a month where the government shut down because they can't agree on how to work out a budget to continue to move forward. And so I think it's definitely trending a good direction, but it's far from solving the problem at hand as well. And so I'm interested to see how how those dynamics play out, and how much longer the shutdown runs. It's not necessarily directly correlated to this, but given that we're taking in more than are flowing out, I mean that should hopefully help in the longer term to maybe get things right. I think that would be in everybody's best interest if we can do that. But it's moving in the right direction, and a lot of the prognostication around the tariffs are going to tank the economy and are going to massively drive up inflation to this point haven't played out. Now, maybe something shifts going forward and it gets worse before it gets better. But this would suggest that we're bringing in a surplus, and we've talked about some of the economic pain and all of these undercurrents, and this is just another interesting data point in that context, in that conversation. But to be honest with you, Mark, I'm interested to watch where this goes, on kind of a go forward basis as well.
I am too. Yeah, I mean, I don't live this like perspective because it is painful to be in the downsides of all of this. But for the health of the country, our kids, and so on, getting this deficit, like figuring out a way to stop the bleeding first and then improve upon, is probably the most important thing. But I have a nephew that is in water treatment supplies, like metal cylinders and those sorts of things, and they're getting devastated by this stuff because they make them overseas and ship them here. I think Tesla said they had a $400 million cost because of tariffs in this past quarter that they reported on yesterday. Just two examples. I mean, clearly there is an enormous amount of pain coming with the tariffs, but it isn't inflationary. It doesn't seem to be so far, and it definitely is leading to some surpluses here. So we'll see. I mean, I think a lot of the pain is that we went from no tariffs to tariffs. And if tariffs are just a reality moving forward, there's certainty in all of that. And maybe the pain subsides over time. I don't know. So I am curious to watch and curious to see what comes out of this government shutdown.
Yeah, no doubt. No doubt. I think the tariffs are a certainty in this administration. Beyond that, it'll be interesting to see who replaces Trump going forward and whether they move to pull all of them back and then introduce a whole new level of uncertainty or not. But yeah, I think you make a good point there, Mark.
Jeff, maybe we should have led with this. Maybe it is more interesting than interest rate and market, I don't know, negativity or whatever we have. I've personally felt like it was important to talk about here because we haven't talked about it a lot over the last little bit. And there seems to be a lot of movement in and around that. But maybe we should have been leading with kind of an interesting thing and along you and I's interests that we're following along, which is an announced partnership between OpenAI and Zillow. That hits right to home with artificial intelligence and real estate. So the two kind of key tags for us. What do you think about this deal?
Yeah, so really interesting. And honestly, I'm still kind of digesting, what some of the implications will be. But as I read a press article that I think was shared with us by a friend of the pod, Frank, if I'm remembering correctly. If not, you can take the credit for it anyway. But the press release was really interesting. A couple of things that stood out to me. One is there's a very intentional integration between ChatGPT and Zillow. So that when you're querying ChatGPT about homes, housing, looking to move to a new market, want to know what your own home is worth, anything along those lines, as I understand it, it will interface directly with Zillow to provide Zillow data, information, even listings, get you in contact, potentially with listing agents for showings and all of that sort of thing in a very integrated and kind of seamless way, I think, through your ChatGPT like chatbot. I look forward to playing with a little bit to see how it actually works in practice, which I haven't been able to do yet. But one of the other things that's really stood out to me, Mark, and was very interesting is in this press release is on the Zillow website, but one of the things they cite is that this is going to give Zillow access to what they cite as 800 million weekly users in ChatGPT. Massive, marketing push, or I think at least access to a whole lot of eyeballs. I think a lot of people go to Zillow naturally anyway, but to find a way to integrate with what is this emerging technology that increasingly, more and more people are using and getting more comfortable and familiar with, to have that kind of partnership is really interesting. I could foresee a lot of other similar partnerships where, it is kind of the new version of Google Ads or something where you're trying to get in front of the people that are doing Google searches. This is the way to do it in a ChatGPT search. And so really, really interesting from a couple of different levels there.
Yeah, I think in that same press release, OpenAI was saying that Zillow is kind of the only real estate app that they're working with to do this. So you see Zillow sort of cornering the market as everybody is trying to lasso in some corner of the market to get competitive advantage. And what I think all these folks see is major changes coming. I was talking to, we talked about Compass buying anywhere. I think it's in that order. Compass buying anywhere, not anywhere buying Compass. And so someone had worked for either Compass or Caldwell, the two brands that are involved in the transaction. And they were talking about the large amount of pocket listings and just bypassing MLS altogether. And, Compass was getting to the size where they can do this and start maybe thinking strategically about being outside of that. So they're lassoing their own segment of the market with major network effects and connections. And Zillow is trying to do the same thing. We see Rocket trying to do that with Mr. Cooper, and just this sort of closed loop. We're just going to buy all the loans and then we'll refinance all the loans and then do your mortgage and all that, but also the marketing arm with Redfin. So there's a lot going on there. And I think everybody is trying to get their piece of what the real estate market looks like for the next 30, 40 years, frankly. What really stands out to me, Jeff, I like this guy's thoughts. That probably shades me in a certain light to a lot of folks, but we talk about Chamath Palihapitiya from our favorite All In podcast. I find that he's willing to say some things that make people uncomfortable, kind of predicting where things go. And when you look back, often they're directionally correct. And as he was looking at this artificial intelligence landscape. He's kind of looking at the browser and the website as a ridiculous and unnecessary go-between between what actually needs to happen on the internet. And because there isn't any alternative, that's what we've been doing, is trying to build these elaborate websites to make the code and the actions available underneath the website accessible to the layperson. But generally what he's saying by saying that in the context of artificial intelligence is that you don't need that clunky, unnecessary middleman of the web page and the internet browser where we're heading to. This is where we get into agents, the AI agents. And so like OpenAI has done a deal with Shopify, right? Well, that's really interesting. Shopify runs the financial backend of most every website out there. And so they're putting out deals together to just go, say to OpenAI, go buy me whatever and go set it up, And so the agent skips the website altogether, and that you are accessing the internet through OpenAI, through Claude, through Perplexity, through Grok. And it just sort of does what is needed to be done. And I think that Zillow, it's a good deal for Zillow here, because I think they are trying to get their code and their data into that OpenAI chat interface, because that's the way of the world. That's where we're heading to. You won't go to Zillow anymore. You'll go to OpenAI to look for all things, to buy toothpaste as well as to buy a house. It's just how it goes.
Yeah, it's just so interesting to try to wrap your head around, what does the future hold in terms of our interaction online, because, yeah, you're right. I mean, most of us have only ever known internet browsers, and go there. And, Jeff Bezos' concept of an everything store in Amazon, was groundbreaking at the time. He started with books. I'm going to sell books, but with the goal all along being to expand that to, you can buy a book or toothpaste or car or whatever, online. I don't know if they sell cars, but maybe I have to shop after this and find out. But I'm always surprised at just the variety of things they have, which was a very intentional vision that is not what it started out as being. And so, is the AI interaction, kind of become the new everything store in a certain way? I mean, it very well could be. And Amazon's not going to take that laying down. How are they going to try to, handle or approach, those sorts of things? It's just really, really interesting to see. But I totally expect that the future of what it means to be connected online and in the internet to, continue to evolve. It may not happen overnight, but I think it's going to look a lot different in 5 and 10 years from now than what we've been used to in this Google 10 blue links and web pages and internet browser, history. That's just the way it evolved, from the time we got online. It wouldn't surprise me to see it look, a lot different than that in the future.
Just as a side comment, I think this is what is so interesting in watching the inaction from Apple. They've got Safari, they've got this enormous deal that is under monopoly scrutiny with Google because Google pays them a boatload of money to have their search be it. But if the browsers are going away, where is Apple's LLM? In getting locked into this, they're ceding that to OpenAI right now, or whoever else negotiates a way in. It's kind of interesting there for a major player just sitting idle with LLMs, not playing this game of kings that we're watching being played. And what are the effects? Because accessing online is, I think, going to be totally different. That seems for sure in short order.
Yeah, they're a very interesting case for sure. And really, I mean, in a lot of ways, they're a hardware company. I mean, certainly they have, software that is intentionally integrated into all of their hardware. But, there's a possibility that, they allow a lot of the heavy investment to take place and then come in once the market is a little bit more mature. Whether that's a winning strategy or not, I don't know. You see most of the other, Mag 7, high value, high cash flow tech companies pouring tons and tons of investment into this. Maybe Apple, falls out of relevancy and falls by the wayside, or maybe, strategically they have something right in the long run, but it's definitely a differentiated approach to what you're seeing with so many of the other players out there in that space.
Well, Jeff, that'll do it. Enjoyed the conversation here. Interesting to see where this stuff goes, and it's I'm anxious for 2026. I think. I mean, we all got to hope and look forward to some things here, but probably a pretty difficult ending to the 2025. And let's hope it's not take your licks in 2026.
I'm hoping that is not where we're headed for sure. I really do believe that reverting back to the mean as far as what we are used to seeing historically in volumes is a real lift from where we're at today. So, of course, we're all hoping for that to happen sooner than later. But there's reason for hope even as we go through these relatively lean times. So we'll be here to analyze it one way or the other.
I think I'm going to start printing T-shirts that says, "If it's 2027, you'll find me in heaven." So we'll see.
At least I hope that's the final destination, Mark. The jury may be out on that too.
All right. Till next time, Jeff.
Hey, good deal.